Keeping up with complex business topics, it often feels like you're just drowning in information, doesn't it? Trying to figure out who's doing what tech matters. It can be overwhelming.
Absolutely. And that's really why we do these deeper dives, to try and cut through some of that noise. Today, we're focusing on a really interesting company, kind of at the forefront of a big shift.
We're digging into Samsara Inc., stock ticker IOT. They're basically aiming to bring physical operations, think trucking, construction, factories, into the digital age.
And our mission, let's call it, for this dive is pretty clear. We're working from a detailed value investing analysis dated May 15th, 2025. We want to pull out the key takeaways and figure out, does Samsara look like a solid long-term investment based on this analysis?
Yeah, we've got a lot of good info here. The core thing seems to be their platform, the Connected Operations Cloud. It's like it uses IoT sensors and data.
Right, sensors on vehicles, equipment, sites.
To gather information, and then their cloud platform analyzes it all. The goal is making operations safer, more efficient, and increasingly more sustainable, too.
Okay, so let's unpack this. What's Samsara's fundamental mission?
Well, their stated mission is pretty straightforward.
Oh, yeah?
Boost safety, efficiency, and sustainability for operations worldwide. They started back in 2015, founded by Sanjeet Biswas and John Bickett.
And these guys aren't new to this game, right?
Not at all. They previously founded Meraki, the cloud networking company. Cisco bought them for, $1.2 billion. So they've done this kind of hardware plus software cloud model successfully before. That's a big point in their favor, that experience.
Okay, so they have a proven track record.
Yeah.
And this Connected Operations Cloud, it's not just about collecting data points, is it? It's about making that data useful.
Exactly. It's an end-to-end system. Takes all that raw IoT data from trucks, sensors, workers, and turns it into, actionable insights that businesses can actually use to make decisions, change processes.
And they claim it delivers real value. They do. They point to an IDC white paper. No, this is often company-sponsored. Keep that in mind. But it apparently cited an average 8x ROI for customers, like over $2 million in benefits per organization.
Wow, 8x.
Yeah. And you also see customer stories talking about, fewer accidents, better fuel economy, even finding stolen trailers using the tracking tech. That kind of tangible ROI is really what drives sales.
Okay, so this cloud platform, what are the actual pieces? What does it do day to day for a customer?
Right. So the core is the platform itself, the data aggregation layer. Then you have the applications built on top. A big one is video-based safety.
Like dash cams?
Yeah, but smart ones. AI-powered dash cams, some facing the driver, some the road. They can automatically detect risky driving, send alerts in the cab, help with coaching, generate safety reports. The idea is preventing accidents before they happen.
That sounds pretty impactful. What else is in the suite?
Then there's vehicle telematics. That's your GPS tracking, but also route planning, dispatch, monitoring fuel usage, scheduling maintenance, making sure truckers comply with ELD regulations.
Electronic logging devices.
Right. And now they're adding features for managing electric fleets, too. There's also equipment monitoring, tracking assets like trailers or generators, whether they're powered or not, seeing how much they're used, diagnosing issues remotely.
So you can track pretty much anything that moves, or even things that don't.
Essentially, yeah. And they have site visibility, too, cloud-connected cameras for watching, say, a warehouse or a construction site, with AI alerts for security or operational issues.
Okay.
And finally, workforce apps. Things like digital forms, compliance checklists for workers, communication tools, all running on mobile devices. Underpinning all this is their own hardware gateways, the dash cams, asset tags, sensors, usually a one-time cost for that hardware.
It's a very broad offering. What ties it all together? What's the magic ingredient?
They call it Samsara Intelligence. And this is where the scale really matters. They're processing a ton of data. The analysis mentioned over 14 trillion data points just in fiscal 25.
14 trillion.
Yeah, and something like 120 billion API calls a year. That's how different systems talk to each other. They apply AI and machine learning to this massive data set to find patterns, predict problems, automate tasks. The analysis really highlights this AI layer built on their unique data as a key differentiator and growth engine. It's not just data. It's a data set that gets smarter with every customer mile driven. Okay, comprehensive products, AI-driven insights. How do they make money from this? What's the business model look like?
It's overwhelmingly subscription-based. Around 98% of their revenue in FY25 came from subscriptions to the platform.
Okay.
These deals are typically 35 years long and, crucially, usually non-cancelable. That provides a really predictable recurring revenue stream.
That's attractive. Very different from just selling hardware.
Exactly. The small remaining slice, maybe 2%, comes from hardware sales and other services, but the core is that sticky subscription revenue.
And who's buying this? What kinds of industries? It's pretty diverse. Transportation and logistics is obviously huge for them, but also construction, field services like plumbers or electricians, food and beverage distribution, government fleets, utilities. Lots of sectors with physical operations.
Are they targeting specific sizes of companies?
They serve a range, but there's a definite push towards larger customers. Maybe they talk about core customers, those spending over $10K a year, and especially large customers who spend over $100K a year. Landing those bigger enterprise deals is key to their strategy.
Right. Bigger deals mean more efficient growth. So lots of industries. How big is this overall market they're playing in?
It's enormous. The whole idea of digitizing physical operations that touches something like 40% of global GDP. It's massive.
Wow.
If you narrow it down, look at, say, IOT fleet management, the core area for Samsara, projections show that market growing fast, maybe 18–19% compound annual growth rate, hitting tens of billions of dollars in the next decade.
Okay.
And then the connected worker market for their workforce apps is also forecast to grow really rapidly, maybe even faster, like 25% CGR by some estimates.
Those are some seriously strong growth numbers. What's driving all that demand?
It's a confluence of factors, really. You've got the constant push for better safety, the need to squeeze out inefficiencies and cut costs, growing pressure around sustainability and emissions.
Oh, ESG factor.
Exactly. Plus regulatory compliance like those ELD rules and just the general trend towards using data to make smarter decisions. And the interesting thing is, adoption is still relatively low for some of these technologies.
Like what?
Well, the analysis mentioned less than half of commercial trucks in North America even use basic telematics and advanced safety systems, maybe only 10%. So there's still a huge amount of greenfield opportunity out there, a long runway for growth.
Sounds like a great market to be in. But they can't be the only ones seeing this, right? Who are they up against?
No, definitely not. It's a very competitive space and quite fragmented too. You've got big players like Verizon Connect, Geotab, LitisX, which is strong in video safety motive, formerly Keep Truckin', and Trimble, which is a big industrial tech company.
Okay, established names.
Yeah, and others too, like Fleet Complete, Teletrac Navman, Azuga. Even Cisco is mentioned, likely leveraging their network expertise. It's crowded.
So in that crowded field, how does Samsara stand out? What do they claim is their edge?
They emphasize a few key things. One is the integrated platform, that single pane of glass idea, managing everything in one place rather than using point solutions.
Makes sense. Avoids juggling multiple systems.
Right. Then there's their AI, powered by that huge data set we talked about. They argue it gives them better insights. They also tout their rapid innovation, releasing new features quickly. And then there's brand reputation, focusing on that ROI for customers, their enterprise sales approach, and a growing partner ecosystem, over 300 integrations with other software. They position themselves as a leader, and they've gotten nods from analysts like Frost & Sullivan for things like video safety and telematics.
So they're definitely working on building competitive advantages. Let's talk about that more directly. Using the classic value investing term, does Samsara have an economic moat? What protects them?
That's the million-dollar question, maybe billion-dollar question here. The analysis suggests they're developing potential moats. First, brand strength. It's growing. People are starting to associate Samsara with safety, efficiency, sustainability. Those customer success stories in the ROI report help build that. Morningstar actually gives them a narrow moat rating, which suggests they see something tangible starting to form.
Okay, brand is one piece. What else?
Network effects, specifically data network effects. This could be huge. The more data they collect from their customers, miles driven, sensor readings, video clips, the better their AI gets.
Right.
Better AI means a better product, more value, which attracts more customers. More customers mean more data. It's a virtuous cycle.
A flywheel effect.
Exactly.
Yeah.
And it becomes harder and harder for competitors with smaller data sets to catch up on the AI front. The fact that over 70% of their customers use multiple Samsara products reinforces this platform becomes more valuable as you add more pieces.
That makes sense. The data itself becomes a barrier. What about making it hard for customers to leave once they're in?
Switching costs. That looks like another potential moat source. We mentioned the multi-year, non-cancelable contracts. That creates some stickiness.
Sure.
But more importantly, when a company deeply integrates Samsara into its daily operations, routing, safety programs, maintenance, compliance, it becomes the operational backbone.
Like United Natural Foods, mentioned in the analysis.
Yeah. Or that big DIY moving company example. Tearing that out and replacing it with something else, that's a massive headache. It's costly, disruptive, risky. And their high dollar-based net retention rates, 115% for core, 120% for large customers show this. Customers aren't just staying. They're spending more over time, adding more vehicles or features. That signals high switching costs.
Is it difficult to switch out? Any other moat sources?
Maybe intangible assets. They're investing in patents. Analysis mentioned hundreds, filed or active, with significant R&D spend tied to IP protection. Their proprietary AI algorithms, the platform software code itself, these are valuable assets that aren't easily copied.
Right.
And potentially cost advantages or economies of scale down the line. They outsource manufacturing, which can be efficient. As they scale their cloud platform, the cost per customer should theoretically drop. We're seeing early signs of this, and they're improving non-GAAP margins and that positive free cash flow.
Okay, so multiple potential moat sources starting to emerge. Let's shift to the people running the show, the management team.
Led by the co-founders, Sanjeet Biswas as CEO, John Bickett as CTO. And as we said, that Meraki success story looms large. They've built and scaled a similar business model before.
That's reassuring. What about the rest of the team?
They seem to have brought in experienced folks from well-regarded tech companies. ServiceNow, Cisco were mentioned. The CFO, Dominic Phillips, came from ServiceNow. The CRO, Amit Vyas, apparently helped scale sales significantly. You need that kind of experience to manage hypergrowth and compete effectively. The board also has some heavy hitters, like Mark Andreessen, Sue Wagner from BlackRock.
Okay, sounds like a capable team. How are they incentivized? Is management aligned with shareholders?
Well, looking at compensation, especially for the CEO, it's heavily weighted towards stock options and awards. Like almost all of it.
So their payout depends on the stock price going up?
Largely, yes. Now, that heavy use of stock-based compensation is a big reason they're still unprofitable under GAAP accounting, and it does dilute existing shareholders over time, but it definitely aligns management's financial interests with increasing shareholder value long-term.
And insider ownership. Do they have skin in the game?
A lot of skin in the game. The co-founders still own very significant chunks of the company. Reports suggest somewhere in the 25–30% range each in terms of voting power. And Andreessen Horowitz is also a major holder. That high insider ownership is usually seen as a big positive by value investors. They're invested alongside shareholders.
Makes sense. You mentioned high ownership, but there were some recent insider sales noted. Should that be a concern?
Yeah, the analysis flagged some sales by Biswas, Bickett, and the CFO in April-May 2025. It's always worth noting insider sales. But you have to put it in context.
How so?
They still own massive amounts of stock. These sales were relatively small percentages of their total holdings. Executives sell shares for all sorts of reasons, diversification, taxes, buying a house, whatever. It doesn't automatically mean they've lost faith in the company.
So maybe not a red flag unless it becomes a pattern.
Exactly. If you saw widespread, consistent selling across the board, that would be more worrying. But isolated sales by founders who are still heavily invested, less concerning. Probably.
Okay. What about governance generally? Ethics, transparency?
The standard details are in their proxy statements and 10K filings. Given their business, cybersecurity governance is key. They seem to have board-level oversight, a CISO, risk management processes outlined, standard stuff for a company this size handling sensitive data.
And ESG.
They put out an ESG report. They talk about helping customers be safer and more sustainable, their own carbon neutrality goals, aiming for net zero by 2040, data privacy. That seems to be on their radar. And they seem reasonably transparent. Investor relations website, regular filings, earnings calls.
All right, so leadership seems capable, aligned. How are they using the company's money? What's the capital allocation strategy?
Right now, it's all about growth. Reinvestment is the name of the game. Huge spending on R&D, hundreds of millions a year. The analysis mentioned maybe over $1 billion cumulatively.
Yeah.
They just opened a new R&D center in India.
So building new products, improving the platform.
Yep, and equally large spending on sales and marketing to grab market share and land those big customers. They're also investing in international expansion, possibly down the road. The analysis notes they may pursue deals, but nothing major recently. And definitely no dividends or share buybacks right now. That's typical for a high-growth company.
So for a value investor, the big question is, are these heavy reinvestments actually paying off?
Precisely. Are they generating good returns on that invested capital? You look at metrics like the strong ARR growth, those high retention rates, the improving non-GAAP margins. Those are the early indicators that, yes, the reinvestment seems to be working. Management talks about durable and efficient growth.
Okay, let's get into those numbers more. The financial performance history.
It's a story of rapid growth. Revenue has exploded from around $250 million in FY21 to nearly $1.25 billion in FY25. That's like a 60% compound annual growth rate over 5 years. Really fast.
But they've been losing money, right?
On a GAAP basis, yes.
Yeah.
But those GAAP net losses have been shrinking significantly year over year. And importantly, other metrics are improving. Gross margins are strong, mid-70s%.
That's healthy for a software-heavy business.
Very. And operating margins are improving too. GAAP operating margin is still negative, but getting closer to break even. And the non-GAAP operating margin actually turned positive in FY25, around 9%.
And the big one, free cash flow.
That's the key recent milestone. They achieved positive adjusted free cash flow for the full year, FY25, over $100 million. That's a major turnaround and a very positive signal.
Okay, positive adjusted FCF is huge. What about some key ratios investors look at? ARR growth.
It's still strong. ARR ended FY25 at $1.46 billion, up 32% year over year. And those large customers, the $100K plus ARR group, grew even faster, up 36%.
Retention rates.
Still holding up well. Around 115% dollar-based net retention for core customers, 120% for large ones.
Valuation metrics, PS ratio.
High. Very high. The analysis put the price-to-sales ratio around 22x based on FY25 revenue. That definitely reflects high growth expectations baked into the price. Price-to-book is also high.
Debt.
Minimal. Their debt-to-equity is very low, practically zero. They have a clean balance sheet.
And returns. ROE, ROIC.
Negative on a GAAP basis because of the net losses. But, as we mentioned, the positive free cash flow and positive non-GAAP operating income suggest the underlying economics are improving. If that trend continues, ROIC could turn positive and potentially exceed their cost of capital. Some sources, like GuruFocus mentioned in the analysis, were already suggesting that might be happening.
So the profitability picture is improving but still mixed, depending on whether you look at GAAP or non-GAAP.
Exactly. GAAP net losses are still there, but shrinking. Management keeps hammering that durable and efficient growth message. Non-GAAP net income was positive in FY25.
And the main difference between GAAP and non-GAAP is?
Primarily stock-based compensation. It's a real cost to shareholders via dilution, even if it's non-cash. So, achieving sustainable GAAP profitability is still the key long-term goal for validating the business model fully. But the path seems clearer now. Scale, those high gross margins, and eventually getting leverage on operating expenses, spending less on S&M and R&D as a percentage of revenue. That's the formula.
And that positive adjusted free cash flow, does it look sustainable?
It's a great sign. Getting to a 13% adjusted FCF margin in Q4 FY25 was impressive. Sustainability depends on continued ARR growth, keeping those retention rates high, and further margin expansion. That growing free cash flow is really what value investors are ultimately looking for.
How does the balance sheet look overall? Financial health?
Looks very solid. They had nearly $1 billion in cash, equivalents, and investments at the end of FY25. Very little debt, as we said.
Healthy liquidity.
Yeah, current ratio, quick ratio, both look comfortable, around 1.5. Positive net current asset value, too. They have plenty of financial flexibility to fund operations and growth.
Okay, strong growth, improving margins, positive FCF, solid balance sheet. What's the market sentiment? What do analysts think?
Generally positive, leaning towards cautiously optimistic. The consensus rating seems to be around moderate buy or outperform.
How many analysts cover it?
A decent number, maybe 10 to 18, depending on the source.
Yeah.
Big names like Morgan Stanley, Wells Fargo, Piper Sandler.
And price targets?
There's a range, naturally. The average seems to be in the high $40, maybe touching $50. High targets go into the $50, even low $60, while lows are more in the high $30s, low $40.
Any recent analyst actions?
Some movement. Piper Sandler apparently raised their target recently, citing positive data checks. A few others might have trimmed targets slightly. But notably, quite a few analysts raised their earnings estimates recently. So the overall trend from analysts seems constructive.
What about recent company news? Anything significant?
Mostly product-focused announcements,
Yeah.
new features for driver recognition, trailer management, emissions tracking, showing ongoing innovation. They did announce a partnership with Hyundai Translead for trailer solutions.
Okay. Any upcoming catalysts?
The next big thing is their Q1 FY26 earnings release, expected in early June 2025. And, the stock itself has been volatile, which isn't surprising for a high-growth tech name.
I'll look at some other market indicators. Short interest. Options activity.
This is interesting. Short interest saw a bit of an uptick recently, according to the analysis. Around 5.5% of the float shorted.
suggesting more bears.
Potentially, yeah, or maybe hedging. The days to cover ratio also increased a bit. And in the options market, the put-call ratio is above 1, meaning more open interest in puts, bets the price will fall, than calls, bets it will rise.
And volatility.
Implied volatility was high, suggesting the market expects bigger price swings soon, maybe around earnings. So while analysts are generally positive, these indicators hint at some near-term uncertainty or bearish bets being placed. Could be noise, could be something more. For a value investor, that kind of disconnect can sometimes spell opportunity if the long-term story holds.
Okay, let's look at who actually owns the stock. The ownership structure.
Institutions hold a very large portion. Reports vary, but it's a clear majority, maybe 65%, maybe even over 90%, according to some sources.
Who are the big holders?
You see major VCs like Andreessen Horowitz and General Catalyst still holding large stakes from early investments. Big asset managers, too, Bailey Gifford, Vanguard, BlackRock, T. Rowe Price, Morgan Stanley Investment Management, Fidelity, a lot of well-known institutional names.
Any notable recent changes in institutional holdings?
The usual churn, some funds adding some trimming. The analysis noted Jennison Associates increased its stake, while Bailey Gifford and T. Rowe might have reduced theirs in some filings. You'd want to watch the type of holders are patient, long-term funds staying in or getting out.
And insiders. We talked about the founders' large stakes.
Yeah. Insider ownership overall is reported as very high, maybe around 60%, largely driven by the founders, Biswas and Bickett, who retain significant voting control. That alignment is still a key positive.
Even with those recent sales we discussed.
Yeah, because the sales were relatively small compared to their total holdings. The fundamental alignment from owning huge chunks of the company remains.
Okay, so heavily owned by institutions and founders. Now the flip side, what are the major risks here? Business and operational risks.
Competition is a big one, obviously. That fragmented market means constant pressure. Execution risk is another. Can they keep growing efficiently, especially selling to large enterprises and expanding internationally? Scaling is hard.
What else?
Achieving consistent GAAP profitability is still a hurdle they need to clear. Innovation risk, they have to keep innovating to stay ahead. And while it's improving, there's still some customer concentration risk, with a large chunk of ARR coming from those $100K plus customers.
Financial risks.
Valuation is the big one. Those high multiples leave little room for error. The ongoing GAAP unprofitability is a risk factor, and that stock-based compensation, while aligning management, does dilute shareholders.
What about risks specific to their hardware business, supply chain?
Definitely. They rely on manufacturing partners, mostly in Asia. So they're exposed to component shortages, lead time issues, geopolitical stuff, particularly anything affecting China or Taiwan, where a lot of electronics manufacturing happens.
And the analysis specifically called out the 2025 U.S. tariffs. How big a deal is that?
Potentially significant. Tariffs on electronics from China could directly increase their hardware costs. Since hardware is manufactured there, it hits them.
How much?
Tariffs could be 25% or even higher on some components. That directly impacts their gross margins on hardware.
Can they just pass that cost on?
Maybe, maybe not. Or they might try to absorb it, hurting profitability. Or it could accelerate efforts to diversify their supply chain away from China, shift assembly elsewhere. It might also push them to emphasize the software and AI value even more, since that's higher margin and not subject to tariffs. But it's a tangible threat to their cost structure and bottom line. And tariffs can have broader ripple effects on the economy, too.
Okay, a definite risk factor to watch. What about regulatory or cybersecurity risks?
Always relevant for a data company. Data privacy rules like GDPR in Europe or CCPA in California carry big penalties for violations and reputational risk.
Right.
They also operate in regulated industries with rules around ELDs, emissions, etc.
Yeah.
And cybersecurity is a constant threat. Data breaches, ransomware attacks, disrupting operations. It's a huge risk. They emphasize their security measures, but it's an ongoing battle for any tech company.
Any other major external risks?
Standard macroeconomic risks, inflation, interest rates, a recession could slow down customer spending. And just the pace of technological change they need to keep running fast to avoid being leapfrogged.
Okay, we've covered a lot of ground. Let's try to bring it all together from a value investing perspective. Based on that May 15th, 2025 analysis, how do you even estimate intrinsic value here?
It's tricky for a company like this. Traditional PE is useless because GAAP earnings are negative. A discounted cash flow, DCF analysis, is more feasible now they have positive adjusted FCF.
But DCF depends heavily on assumptions, right?
Hugely. You have to project growth rates, future FCF margins, figure out the right discount rate, WACC. Small changes in assumptions can lead to wildly different value estimates. The analysis mentioned conflicting public estimates, one very low, another suggesting fair value or slight overvaluation at the time. It highlights the uncertainty.
What about comparing multiples?
You can look at PS relative to peers, but again, you have to be careful because profitability varies so much between companies. Samsara's PS is high, reflecting growth expectations. At the end of the day, a value investor wants to estimate the potential for long-term owner earnings, sustainable free cash flow.
So given those valuation challenges and the current price around $47, $48 back in mid-May 2025, what about the margin of safety?
Based on the analysis from that date, it looks questionable. With intrinsic value estimates varying so widely, and some potentially below the stock price, plus the lack of GAAP profitability, it didn't scream bargain.
Not much room for error.
Exactly. Value investors usually want a significant discount, especially for growth companies that aren't yet consistently profitable. The market seemed to be pricing in a lot of future success already.
So considering everything, the growth, the moat potential, the management, but also the risks and the valuation, what's the final recommendation from a value perspective as of May 15th, 2025?
Okay, synthesizing it all. Samsara is clearly a fast-growing company. Compelling products, big market, smart management with a track record. Finances are moving in the right direction, especially with positive free cash flow. A potential moat seems to be developing. Lots to like. But the lack of consistent GAAP profits is a hurdle for traditional value investors. The valuation was steep, likely pricing in years of strong growth already. Execution risks remain, competition is fierce, and external factors like tariffs add uncertainty.
So not a clear buy signal for a value purist.
Not at that specific point in time, according to the analysis. For existing investors with a long-term view and high conviction, maybe holding makes sense. But deploying new capital at that valuation, needing that margin of safety, didn't seem compelling.
So the recommendation was?
The recommendation was a dull. Intriguing business, definitely one to watch closely. Look for continued execution, a clear path to robust GAAP profitability and FCF generation, and perhaps a more attractive entry point if the valuation comes down relative to the fundamentals.
Okay, so to wrap up this deep dive, Samsara, impressive growth, innovative tech, building a potential moat. But as of mid-May 2025, the valuation looked demanding and GAAP profitability wasn't there yet, making it a hold for new money from a strict value perspective. Needs a better margin of safety.
Precisely. Which leaves a key question for you, the listener, to think about. The potential for IoT to transform physical industries is huge, right? So are the risks and the high valuations we see in companies like Samsara justified by that long-term potential? And if you were watching Samsara, what specific metrics, financial or operational, would you focus on to really gauge if they're successfully turning that potential into sustainable profits and cash flow?
Some really important things to ponder there. We hope this dive gave you plenty to think about. Thanks for joining us as we explored Samsara.